Picture this. You are a hunter in Africa, 50,000 years ago. You just brought down a massive antelope. Your family is fed for weeks. But your neighbor, 3 camps over, he has something you need. Shells from the coast, beautiful, rare, impossible to find unless you live near the ocean. So what do? You can't exactly carry a dead antelope across the savannah to trade it. You can't eat those shells. You can't wear them or build shelter with them. And yet, your neighbor wants them so badly he might actually give you those precious shells for nothing. This moment, right here, is the birth of money. Not coins, not paper, not digital numbers in a bank account. Just the realization that certain things that seem completely useless, can be more valuable than things that keep you alive. This is the story of how humans invented the single greatest tool for human cooperation ever created. And it gets weird. For the first 200,000 years of human existence, we didn't have money. We had barter, direct exchange. I give you this, you give me that. Seems simple, right? Except it's a nightmare. You need goat meat, but the goat herder needs fish, and the fisherman needs woven cloth. The cloth maker needs copper. The copper miner needs shells. And guess what? No one has what the goat herder actually wants, so nothing happens. Everyone stays miserable. Your entire civilization is stuck because you can't figure out how to trade efficiently. This problem nearly killed human civilization multiple times, and then someone had the most genius idea. What if, instead of trying to find someone with exactly what you need, we all just agreed that a certain object has value? Not because it's useful, but because everyone says it has value. The first money was never coins or paper. It was whatever was rare enough that people wanted it, but common enough that everyone could access some. Seashells. That's what most ancient civilizations used. Shells are perfect. They're beautiful, they don't rot, they're light enough to carry, but rare enough that you can't just pick them up whenever you want. In the Indian Ocean, cowrie shells became so valuable that they literally shaped trade routes for thousands of years. People sailed across entire oceans just to collect shells, not to eat them, not to build anything with them, just to have them, because they were money. Then, around 3000 BC, something changed. Humans discovered metal, and metal money was different. Copper, bronze, gold, silver. These metals could be melted down and reformed. You could standardize them. You could make them all the same weight, the same purity. Suddenly, for the first time in history, money became predictable. A piece of gold in Egypt was worth the same as a piece of gold in Mesopotamia. This seems obvious now, but imagine how revolutionary this was. Before metal money, you had to negotiate every single trade. Is this shell worth that fish? What about 2 shells? 3? Now you could just agree on a weight. 1 gold coin equals 10 fish. Done. No negotiation, no confusion. But here's where it gets interesting. Humans realized something crucial. Money doesn't actually have to be valuable. It just has to look like it's valuable. Around 1000 BC, China invented paper money. Paper, the most useless material on earth. You can't eat it, you can't build with it, you can't wear it. Compared to gold, it's trash. And yet the Chinese government said this piece of paper is worth 10 gold coins, and people believed them. Not because the paper was special, but because the government backed it. Meaning if you brought that paper to the king, he would give you 10 gold coins. The paper was just a promise from the most powerful person in the world, and people believed in that promise. This is the real secret of money. It's not about the object, it's about the agreement. Money works because we all collectively agree it works. You could make money out of anything. Rocks, feathers, glass beads, even dirt. And throughout history, humans have. But money only gains value when someone powerful, usually a government, says it has value and proves they mean it by trading real goods for it. Once that happens, everyone else starts believing too. And suddenly, you have a functioning economy. The invention of money completely transformed human civilization. Before money, the largest cities had a few thousand people. After money, cities exploded to tens of thousands, hundreds of thousands. Why? Because money allowed for specialization. A farmer could grow wheat, sell it for money, and buy everything else. A blacksmith could make tools, sell them for money, and trade for food. A priest could pray, be paid in money, and live off that. Before money, you had to be good at everything: hunt, farm, build shelter, make clothes. After money, you could be extremely good at one thing and terrible at everything else, because you could pay someone else to do the things you couldn't. This sounds great, and in some ways it was. But money also created something terrible: inequality. For the first time, it was possible for one person to accumulate massive amounts of wealth while others had nothing. In a barter economy, how much wealth can you actually accumulate? You can only eat so much meat. You can only wear so many skins. Your storage is limited. But with money, there's no limit. You can accumulate infinite money. And the more money you have, the more money you can make. It compounds. A rich person can lend money to a poor person and charge interest, making even more money. A poor person can never catch up. For the first time in human history, we created a system where the poor could be poor forever and the rich could be rich forever. Then, around 1500 AD, something even crazier happened: banks. Humans realized that instead of keeping your money as physical objects, you could put it in a bank and the bank would give you a piece of paper saying they owed you that money. This was revolutionary. You could send money across the world now just by sending a letter. You didn't have to transport thousands of gold coins across dangerous trade routes. Just write a note, and when you arrived in another city, the bank there would give you the gold. Banks started lending out money they didn't actually have. If 100 people came to a bank and deposited gold, the bank would keep maybe 20 of those in reserve and lend out the other 80 to other people for interest. This multiplied the money supply. There was more purchasing power in the world, which meant more buying, which meant more production, which meant faster growth. But this also meant that if 50 of those 100 people came to the bank at the same time asking for their gold back, the bank would fail. They didn't have enough. This is a bank run, and when banks fail, entire economies collapse. The Great Depression happened partly because of bank runs. Millions of people tried to get their money out at the same time. The banks failed, and suddenly everyone's life savings vanished. Money, it turns out, is fragile. Then in 1944, after World War II ended, the world invented something new: a global money system. Every country agreed that their money would be worth a fixed amount of gold. This was the Bretton Woods system. A dollar was worth a specific amount of gold. A pound was worth a specific amount of gold. Every currency in the world had an anchor to gold. This meant countries couldn't just print infinite money to pay for wars or public projects. They were limited by how much gold they had. And for about 25 years, this system worked. The world experienced massive economic growth. Everyone got richer together. Then, in 1971, the United States did something shocking. President Richard Nixon announced that the dollar was no longer backed by gold. The United States had spent too much money on wars and space programs. They didn't have enough gold to back all the dollars they had printed, so they just stopped. They announced that the dollar wasn't worth any specific amount of gold. It was just worth whatever people thought it was worth. And the weird thing? The world kept going. The economy didn't collapse. Money didn't become worthless. Why? Because everyone realized that money was never really about the gold anyway. Money was about trust. The United States was powerful and stable, so the dollar stayed valuable. If the United States seemed weak or unstable, the dollar would lose value. That's it. That's all money is: agreement plus trust. Since 1971, money has become increasingly abstract. Credit cards are money that's not even physical. You're buying things with a promise to pay later. Then came digital banking, money that only exists as numbers in a computer. You never see it, never touch it, but you can buy things with it. Then came cryptocurrency, money that has no government backing at all, no central bank, just code and consensus. Bitcoin, Ethereum, thousands of digital currencies exist now. They work the same way as every other form of money. People agree they have value. As long as that agreement holds, they're valid money. The invention of money is one of the most underrated discoveries in human history. We treat it like it's obvious, like money always existed. But 50,000 years ago, the concept that a useless object could be more valuable than food would have seemed insane. Yet that one idea, that collective agreement to assign value to something abstract, created the foundation for every civilization that followed. It allowed humans to specialize, to cooperate on massive scales, to build cities and nations and empires. It also created inequality, poverty, and economic collapse. Money is powerful, and like all powerful things, it can be used for incredible good or terrible harm. All it takes is trust.